Many investors are wondering if they're making a huge mistake and putting themselves at risk by being invested in an S&P 500 index tracking ETF. They are worried that the US dominance might be under threat and the current high valuations might result in a prolonged period of low investment returns or even a total US market crash. Well, they might be right to worry. In this video, I'll make the case why investing in a globally diversified equity ETF might be the superior long-term choice for most investors. And at the end, I will explain the criteria for choosing such ETF and show you some personal favorites for both US and international investors. My first argument is that even though most investors will simply point out to the fact that the US market simply outperforms international markets, historically looking, that has not necessarily been the case. So let's first look at this chart. This is the performance of the US versus global index funds from 1969 until 2011. From this, you can see that if you have invested in the beginning in both US and global ETFs, your investment in the US will trail that in global stocks majority of the time. Matter of fact, if you look at that period up to 1989, global stocks mostly outperformed US stocks for that period. And also, if you look into the 2000s period known as the US lost decade in stocks due to the dot-com bubble followed by the 2008 financial crisis, the same trend of international outperformance also persists. Well, you might say that's all good, however, after the year 2010, the US market has beaten international markets by a lot. And you will most certainly be right. This has mostly been a result of the huge growth in tech stocks that now dominate the US market. But there is also something else that is growing with a similar pace, and it is the valuations of these companies. For that, we can look at the famous S&P 500 Shiller PE ratio, also known as the CAPE ratio, which is a stock market valuation metric that divides the current stock prices by the average of the past 10 years inflation-adjusted earnings. It basically shows the current US market valuations, where typically higher figure indicates lower future long-term returns and a lower figure shows just the opposite. This rule can be violated for a long period of time, but statistically it does tend to hold at least eventually. For example, you can look at the spike in valuations in the years 1929 and 1999, which are then followed by major crashes. Currently, the US market is sitting near a Shiller PE of 40, which is measurably higher compared to other markets. Now, that does not show that the US market is necessarily going to crash, but it can mean that we might see a prolonged episode of very low returns that can last for more than 10 years. Something that Ray Dalio, the founder of Bridgewater Associates, one of the largest hedge funds, has described as a lost decade for stocks.
Nowadays, the structure of the markets and where everything is priced will give you probably a return in the vicinity of 4%. Okay. 4%. Okay, something that might not equal inflation, probably it'd be very close, and then you have to pay taxes on it.
So what I'm trying to say with this is that I believe the US market is not inherently superior to international markets. The main reason many investors believe this is because of something called recency bias, which is a cognitive tendency to overemphasize recent events when making judgments. Saying that, this also does not mean that the US market will necessarily underperform the rest of the world markets in the future. A globally diversified ETF ensures that investors own the entire global stock market, which includes both US and international stocks. Matter of fact, currently market-weighted global ETFs hold anywhere between 60 to 75% of their entire weight in US stocks, reflecting the US market's large share of global market capitalization. There is another risk associated with being invested in a single country, which also connects to the recency bias that I spoke about. Many people assume that the US has superior stock market returns because it is and will continue to be the greatest economic and military power in the world. Although currently true, that hasn't always been the case historically. If you look at this great chart from the Ray Dalio's book, The World Changing Order, it represents a rough estimate of relative standings of great empires. From it, you can see that historically speaking, the US has been a great power relatively recently. Before that it was the United Kingdom, before it was the Netherlands, and before that was China, which has also seen a big rise in recent history, accompanied by a softening of the US dominance. So what I'm saying is that times change. No one can accurately predict if a specific country will outperform the rest or not, but betting on a single country definitely puts you at a greater risk. For example, if you look at this interesting chart that shows what percentage of equity markets a specific country held since the year 1900, you can see some very interesting things. Firstly, if you look at the UK, you can see how in the year 1900 it represented 25% of equity markets, being the biggest single market at the time. But as its relative standing as a great economic power decreased relative to other countries, this percentage slowly evaporated. But even more interesting, we can look at Japan here, which in the year 1989 represented 45% of the entire market, while the US represented only 29%. Back then, the Japanese market had 8 out of the 10 biggest companies in the stock market. And for many, it also seemed like this growth was going to continue long into the future. Here is, for example, the historical CAPE ratio that determines valuations of the Japanese stock market that got ridiculously high around the period of the year 1990, leading up to a massive crash. After the market crashed that year, it took about 35 years for it to recover back to 1989 levels. Even if you look at that same confusing chart now, with all of the available markets included, you can see that the Japanese market was substantially more overvalued compared to all of the other markets. And today, the US market is the most overvalued one. If we compare it to markets like Europe and China, you can see that it has a noticeably higher CAPE ratio, even if it's not as drastic as the Japan's example previously. As Ray Dalio also have said, the times ahead will be radically different from those we have experienced in our lifetime, though similar to many times before. I want to also point out some additional major concerns for US investors, which are specifically pointed at investors that invest in the S&P 500 index fund-based ETFs, which is the most popular US index fund. And it is that even though many investors believe that by buying this you get a wide representation of the US market, you're actually missing out on investing in the majority of the US publicly listed companies. There are somewhere in the vicinity of 5,000 publicly traded standalone companies in the US, and the S&P 500 only covers the 500 largest cap companies in the US, where there is no statistical advantage of higher long-term returns for large cap stocks over small and medium cap stocks, which leaves the majority of the US companies out of the S&P 500 index, meaning that you're missing out on companies that are still relatively small but could turn out to become the next Amazon, Google or Nvidia. The final benefit that I want to mention is that additionally to increasing your diversification across different markets and industries, world ETFs also offer currency diversification. Diversifying currency exposure provides a natural buffer against local inflation and the potential depreciation of an investor's home currency. This benefits all investors, but is especially true for investors outside of the US. So for example, if you are a European investor and you decided to invest in the S&P 500 exactly 1 year ago, your returns in US dollars will be around 15% as of recording this video. However, if you translate that to euro, you would have achieved only slightly more than 2% annualized return, compared to more than 14.5% if you are invested in the Stocks Europe 600 index with the euro currency, which is the European equivalent of the S&P 500 index. And for a US investor diversified in the European market, that equates to over 30% yearly return if you invested in US dollars. So now, as promised, I am going to show you how you can choose a global equity ETF by filtering based on some criteria that are important for an investor. And then I will show you examples of some ETFs that meet those criteria. Firstly, an important consideration is the ETF's total expense ratio or TER, which is an annual percentage fee deducted from the fund's assets, which impacts your net returns. So by choosing an ETF with lower TER, you ensure higher long-term returns, since the ETF's fees will not eat away too much out of your returns. Second important thing is the tracking difference, since these ETFs track underlying indices and ensuring they are tracking them correctly is crucial to ensure no divergence from the results of the underlying index. There are three main ways that an ETF tracks an index, and they are either a full replication, meaning buying all underlying companies in an index, Sampling, which is investing in a sample of the stocks in an index which have the goal of simulating the results of the underlying index, and swap-based sampling, which uses different kinds of so-called financial wizardry to track the underlying index fund, which could bring additional risks to your investment. So I personally stay away from this replication method. The last two things I look for is a solid fund size of more than 500 million US dollars or euro, and lastly, I look if the ETF is either accumulating or distributing, meaning if it either pays out dividends to shareholders or reinvests them back into the ETF. Now, I won't get too much into details about how I filter and research them in this video, but if you're interested on how it's done, put it in the comments if you want to see a future video on how to do that. However, I will now suggest two ETFs that meet those criteria. So for US investors, one of the best globally diversified equity ETFs is the Vanguard Total World Stock ETF, which currently holds around 10,000 stocks. The fund seeks to track the performance of the FTSE Global All-Cap Index and have the incredibly low expense ratio of only 0.06%. The Vanguard Group is famously known for its founder as well as pioneer of the concept of low-cost index investing, Jack Bogle. And for European investors, I suggest the SPDR MSCI All Country World Investable Market UCITS ETF Accumulating, which currently holds almost 4,500 stocks. The fund seeks to track the MSCI All Country World Investable Market Index and currently has a TER of 0.17% and reinvests its dividends back into the ETF. Vanguard also has a European ETF, but it has a higher TER of 0.19% and a lower number of holdings in comparison. Nevertheless, do not just take my advice blindly. Make sure you do your own research when picking what to invest in, so you can evaluate what is best for your situation. If you enjoyed this video and want to see more finance and investing content, make sure to check these videos out. Hope to see you in the next one.